We're here for the Aspen Economic Strategy Group meetings, of which you're a part. It is about the economy. Last time we talked, you were projecting at Bank of America a recession, mild recession, maybe Q4 into Q1 next year. You've changed your mind. Why?
Well, first of all, it's a great setting. It's a beautiful setting, and there's a lot of great people here to talk about the economy. But our team basically has moved from a slight recession to no recession. And so in early next year, first quarter, second quarter, they had a slight negative quarters. They now have positive 1% and 0.5% positive. But the more importantly behind that is what's really going on in terms of the unemployment rate projections. They're now at 4.3 peak unemployment in the latter part of 24, early 25. You're saying that's sort of an unemploymentless slowdown, which is really what's going on, and we can talk more about it, but that's what's really going on is people are employed, they have money, they're spending money, and the Fed is trying to slow down the economy, and it looks like we're reaching a pretty good equilibrium.
You've said it's hard to have a recession when you've got unemployment in the fours. That's
right.
Awfully hard to do. But what are you seeing in terms of jobs? Is there any softening in the market at all? Are you seeing at Bank of America or more broadly?
Well, if you talk to our clients, you sort of see very specialized roles. Welders are still in high demand, even because construction's going on and all in the IRA and all the different building. That's one thing. But in general, if you take our company's example, last year this time it was a great resignation. Turnover was back up to 15%, which was higher than pre-pandemic. It's now down to 7 to 8%. Last year we hired 3,700 people in the month of June. This year we hired 900. I mean, and yet headcount keeps drifting down. And so I think a lot of employers are doing that same thing, which is managing headcount carefully. And that's why you've seen job openings drop by 20% in the last 12 months or so. It doesn't mean people are laying a lot of people off. That's happening a bit here and there, really specialized industries. But people are being much more conservative in their employment. Last year it was you posted every job known to man because you didn't know what was going to happen. Now with the lower turnover, the labor market is a lot looser this year than it was last year, although the unemployment rate is still low.
One of the things you have a lot of advantage into is consumer spending at Bank of America. What are you seeing in consumer spending? The consumer seems to still be spending, maybe softening a little bit, but how much dry powder do they have? Because we had thought they had a lot of excess savings they can still express. We're now hearing, for example, credit card balances are really going up.
Yeah, so if you think about a consumer, it's their wages and wage growth, it's the money they have in their accounts from the stimulus and other things that went into their accounts during the pandemic. It's their ability to borrow. And then it's the rate at which they have to pay to borrow. And so if you think about all that, what we see is consumer spending. If we were talking last year's time, it was 10% year over year. And that was inconsistent with a low inflation economy. That now is down to 5%. So you've seen it drop by half. And so year to date it's 5%, month of July is 4.5%. So you're seeing it slow down. And what it's spending at in the month of July is consistent with a lower inflation. It's very much like it was in 17, 18, and 19 as the Fed raised rates and the economy sort of settled in. And so I think there's always been this battle between the consumer and the Fed, and the consumer has won the battle back a bit, but they got to be careful of overwinning it now. And now the risk really goes to over-tightening and slowing down the consumer too much, and then we would have a recession.